What's going on, investor family? I'm Stock Market Jay, and I'm here to say today. So using the company's price to earnings ratio, also known as the PE ratio, is going to be a great way to determine whether a company is going to be overvalued, selling at a fair market value, or if it's going to be undervalued, all right? So what the price to earning ratio does, it compares a company's stock price to its actual earnings, okay? And that gives you a multiple of how cheap or expensive it is to own that company. Okay, so companies with a higher PE ratio are going to be more expensive to own, and the ones with the lower ones are going to be more cheaper to own. Okay, so an overvalued company would have a PE ratio of 18 and above. Fair market value will be 15 through 17, and undervalued is going to be 14 and below. So the value investors, your dividend investors, which are alike in many ways, they're going to want these companies that are undervalued, okay? That's where you're going to find the most bang for your buck at. That's where a company has strong earnings, but the stock price isn't really ballooned or bubbled yet to the point to where the stock market has actually caught up with it, so it's cheaper to own that company, all right? The company earns more money than the stock price suggests, so in turn, you end up getting more bang for your buck, which is going to be what you want. All right, so how you determine the price per share is going to be, for example, let's say you have a company selling at $20 per share. That's the price. And let's say they earn $4 per share. $4 per share. All right, so this company would have a PE multiple of 5. All right, so let's take this same company. Let's say the stock price goes up. Let's say the stock price goes up to $24 a share. And then, but the earnings stay the same at 4. So now the PE just went up to 6. So now that company is more expensive to own. All right. The value investor in me wants the cheaper company. So if a company's stock price go up, I'm going to want the earnings to go up. All right. If a stock price goes up and the earnings stay the same, well, that means that the company is not earning as much money as the stock price is suggesting. So now that company is becoming overvalued, all right? And that's what we don't want. So your growth investors, they don't mind paying a premium to own these companies. They don't mind paying, having PE ratios of 300, of 200, of 60, things like that, because they're going to get the value and the actual growth that the company sees and the actual growth that the stock suggests. The value investor and the dividend investor in me, I want a low multiple because I want these companies to be cheaper to own. I don't want a company where they're growing, the stock price is growing and it's becoming detached from the actual company's fundamentals, right? The actual, what the company actually does and what it stands for. I want a company that stock price is going up and just is the same. The earnings per share, the earnings that the company is make is going up in turn. All right, that's how you find the most bang for your buck. You want a company that the stock price, even if the stock price is detached from the actual business and the stock price isn't that high, and that PE multiple is low, and that the actual number for the earnings are increasing, okay, they're beating those earnings every quarter, that's what you want as a value and as a dividend investor. All right, guys.